Imagine watching the stock of a major airline. Out of nowhere, the price is slashed in half. $50 a share suddenly becomes $25. If you treat this like a trip to the grocery store, your instincts suggest you found a bargain. When a bag of rice or a pair of shoes is marked down by 50%, we naturally assume it's cheap. Financial markets operate on a different logic. In trading, the idea of intrinsic value, a fixed logical dollar amount, is often a dangerous illusion. That airline stock didn't drop because it went on sale. It dropped because the market collectively decided its previous price was wrong. The current market price exists as an absolute truth. It aggregates every piece of known information and the collective actions of every participant at this exact second. Buying a stock because you believe it is supposed to be worth $50 means arguing with the market. Success requires following the price as it actually is, rather than fighting for what you think it should be. Curious, if a stock's price isn't tethered to an objective value, we have to look at what is actually pushing it up and down. The market is moved by the collective, raw emotions of millions of traders, specifically fear, anxiety, and hope. These emotional states dictate the forces of supply and demand. Every second the market is open, buyers driven by hope and sellers driven by fear engage in a constant tug-of-war. When one side begins to overpower the other, we see market sentiment, the prevailing direction the crowd is currently favoring. To remain profitable, a trader must identify these invisible emotions in real time, effectively reading the mind of the crowd. Price charts provide a visual map of collective human feeling. If you watch the lines closely, you'll see that price breathes, shifting in a series of alternating waves. On this diagram, we see the impulsive wave. This aggressive, momentum-heavy push moves in the main direction of the trend. When you see this sharp green climb, you're watching the crowd surge forward on pure hope. Eventually, that momentum exhausts itself as buyers lock in their profits. This creates a shorter, red downward move against the trend, the corrective wave. It is the market pausing to catch its breath. We identify the emotion of hope through a specific geometric sequence. Each new peak, the higher high, pushes past the last one. Each pullback, the higher low, rests above the previous floor. This stair-step pattern confirms an upward trend. In a live market, the candlesticks follow this same structure. Despite the messy daily fluctuations, the sequence of higher highs and higher lows marks the clear path of the buyers. When fear takes over, the geometry inverts. The crowd enters a full retreat, leaving behind a sequence of lower highs and lower lows as sellers squash any brief attempts to rally. Mastering these wave patterns allows a trader to translate chaotic sentiment into a clear, actionable direction. Sometimes the tug-of-war stalls out. Neither fear nor hope is strong enough to move the rope. The market enters a sideways or neutral trend. As the magnifying glass shows, impulsive movements vanish during this phase. Price action becomes trapped in a cycle of corrective oscillations, bouncing between a flat resistance ceiling and a support floor. This suggests a state of pure indecision. Traders stay on the sidelines without a consensus, waiting for a catalyst to break the stalemate. Since the direction is unconfirmed, many traders wait for the price to physically break out of this neutral zone before committing their capital. Trends follow a life cycle. To protect an account, a trader must recognize when the crowd's dominant emotion is beginning to shift. A trend begins to break when its structure fails. This occurs when a market stops pushing into a new higher high or fails to drop into a new lower low. Markets frequently exhaust themselves when they succumb entirely to extremes, either euphoric buying or panic selling. In late 2017, the public was convinced Bitcoin would go to the moon. This widespread euphoria signaled the exact top of the trend. 6 months later, the asset had lost 70% of its value. These emotional peaks often coincide with a massive spike in trading volume. This surge indicates that a final, massive wave of participants is jumping in at once, which often exhausts the remaining momentum at a psychological price level. Experienced traders often avoid trying to predict the exact top or bottom. Instead, they accept the current trend as it is and trade in its direction. The strategy is to wait for the market to establish its emotional direction, use the small corrective waves to enter with less risk, and let the objective truth of price guide the trade.